All right, so tax due to the IRS. Again, it's going to be the tax tables that we're going to use, and you've already jumped to those tax tables. One thing I do want to mention, so some of the wording on the problems is really bad. They say, there's one problem in particular where it says, and this is in chapter 1, calculate tax liability using the tax tables and the schedules. There's only one spot. It should not say that. It should say to use the appropriate method. Now remember, for the the appropriate method would be dependent upon taxable income. So if taxable income is under 100,000, you can use the tax tables. If it's over 100,000 or 100,000 and over, you have to use the schedules. Okay? Other problems do use that wording, but there is that one problem there that says and that's not appropriate. So, and we've already gone through and used, done these calculations, and you've already done, so I'm not going to spend a whole lot of time on going through this. We all know that the tax tables and the tax schedules that we use are going to depend on what our filing status is, right? Tax tables stop at income of less than 100,000, so you've got to use the schedules if the income, taxable income, not total income, taxable income is $100,000 or more. I don't know why they put this in here. I really don't, because we've got another, we have another credit that we could talk about. But for some reason they put this child tax credit in here. Child tax credit, oh, you know what? I know why they do it. Because you have a problem. You have a homework problem. I think it's one of your tax return problems. There actually is a spot where you have to use the child tax credit, but they tell you what it is. So the child tax credit is $2,000 per child. If I'm remembering right, and they haven't changed it, the problem has one child, so it would be a $2,000 tax credit. Child tax credit acts to reduce that tax liability. It goes on page 2 of the form 1040. There's also a separate schedule. When we get to chapter 9, we're going to talk a lot more about it and do some calculations. There are phase outs for that child tax credit, and we'll do those calculations, but not until chapter 9. Total tax liability. This does not mean that this is how much you have to pay. This is how much you owe for the year. This is your total taxes. You may have already paid it in with the withholding or with estimated payments, right? And that's the line that is, well, it shows up for our purposes. I mean, it shows up on the very first line. I think it's line 16 on page 2 of the 1040. And then if there are any other credits or anything, they get mixed in with the ultimate result here on line 24. Tax payments, usually it's through withholding, and you remember on the page 2 of the 1040, there's a spot on there for withholding from W-2 forms, withholding from 1099 forms, which is less common. And then we also have, and that's what they're talking about here. So the 1099 forms, this is if somebody receives interest, dividends, rent income, royalties, pension plan distributions. So it could come from the 1099s, could be from retirement distributions. That's where the 1099 withholding would come in. That is reported in that same section for tax payments or estimated tax payments. These are amounts, again, that have been paid separately directly to the IRS, from the taxpayer to the IRS, usually through an electronic withdrawal. And normally speaking, these are people who make these payments are business owners. They own what are called individual or sole proprietorships that are reported on the Schedule C. This is our chapter 6. And they've got income that it's not subject to withholding. So they have to make those estimated payments throughout the year, four of them through the year, or sometimes retirees as well. Those are the most common times when somebody makes estimated payments, but those are also included in these payments payment amounts, so the withholding, as well as the estimated. Oh, I suppose I should make mention of this, although I think we go into more detail on this in another chapter, but I will go ahead and mention this here. So taxpayers have to make those estimated payments based on what's called a required annual payment. This is a big part of tax preparers' jobs too. When they're preparing a tax return, not only are you preparing it, which is a retrospective look at what has already happened, you're also prospectively giving the taxpayer estimates of what their tax is going to be the next year. So one of the things that they do is taxpayers will make calculations for clients based upon their best information at the time of what those estimated payments are going to be. Because your first estimated payment is due April 15th. Well, if you've just had your taxes done, you don't, the timing, it's a bit of a time crunch there to get that estimate together. But that's part of the tax preparer's job, is to the best of their ability to give the taxpayer an estimate of what they're gonna owe next year based on the information that the taxpayer has given them. And oftentimes as well, what happens is that tax preparers will make sure that their clients who have estimated payments will come in sometime, maybe about this time of the year, so they can see what has happened. How close did we get? Do we need to make an adjustment to those last two estimated payments for the year so that we're sure that you're paying enough in? But there is a required minimum payment that has to be made, and that is called a safe harbor amount. And what that means is, even if, as long as you meet that safe harbor requirement, you will not suffer any penalties for underpayment of estimated taxes. So if your safe harbor amount is $10,000 and you paid in $11,000, but it turns out that you actually owed $20,000, you're not going to get penalized on an underpayment. As long as you paid in what that safe harbor is, and that's the calculation that's done by the tax preparers. And there are two safe harbor amounts depending upon the adjusted gross income of the taxpayer. So it's the lesser of 90% of the tax shown on the return, or 100% of the tax shown on the return for the preceding year. So whichever is less. So as long as you pay in 100% of what you owed last year, or 90% of what you owe this year, once that whole calculation is done, then you're in the safe harbor. You've paid in enough, you won't be penalized. You still owe the tax if you owe additional amounts, but you won't owe any penalties. And it has to be each of those estimated payments then, that's how those estimated payments are calculated, and they're 4 equal payments that are made. They're called quarterly payments, but they're not actually done quarterly. April 15th, June 15th, September 15th, and January 15th is when they're due. Did I get that right? Yep, September 15th. They say January 16th here and April 18th because the due dates for IRS payments as well as forms is always, whatever the due date is, if it falls on a holiday or a weekend, it's the next business day. So that's why they're saying April 18th here. Next year it must be, it's funny, there's a holiday in Washington, D.C. It's called Emancipation Day. That's always on the 15th of April. So because it's in Washington, D.C., the IRS is closed. So this is probably, there's a weekend and then Emancipation Day, or Emancipation Day is before that weekend, and that's the next business day. So that everybody gets that holiday, even though it's only in Washington, D.C., but that's because the IRS is closed. If the taxpayer has an AGI over $150,000, the safe harbor changes. It has to be at least 100% of this year's tax due, or 110% of what you owed last year. Essentially what this does is it allows taxpayers, if you got surprise money you weren't expecting, or you just didn't plan for, it's saying, okay, well, you can plan for it based on what you did last year. You or not you can plan for it, but you can estimate based on what you did last year rather than this unexpected amount this year. So, and again, it's the lesser of whichever two those are. There are penalties for failure to make those estimated payments. Penalties plus interest if it's an underpayment. But they're not assessed a penalty if the difference between the tax shown, so here's another safe harbor, if it's under $1,000, there's no penalty. So those penalties kick in after $1,000 and after $1,000 of tax due and after these safe harbor amounts haven't been reached, okay? And here's a little, so here's a good flow chart if you're gonna have to pay estimate. Well, you owe 1,000 or more after subtracting income tax withholding and credits. No, you don't have to pay tax. Yes, will your income tax withholding and refundable credits be at least 90% of the tax shown on your 2023 return? Yes, you're not required to pay. No, will your income tax withholding and refundable credits be at least 100% of the tax shown on your 2022 return? Yes, you don't have to pay. No, you have to make estimated payments. So, all right, I'm not going to go through all that. Well, maybe I will, just to kind of help solidify. We've got Janice. Let's learn about Janice. So Janice is single. Her taxable income, so this would be the amount on the last line of the first page of her 1040, is $55,460 in 2023. She had total tax liability for the year of $7,512. Next year, during 2024, she's only going to work part-time, and she thinks she's only going to earn $25,000. So maybe she's going to retire, who knows. And she estimates that her income tax withholding is going to be $4,100. So she's having a dip in her income. She receives additional income from selling paintings. Based on her expected painting sales and wage earnings, she expects her tax liability for 2024 will be $5,764. That's really precise, by the way. I'd round that up to $6,000. But to avoid an underpayment penalty, she has to make estimated payments. Her required annual payment is $5,188. So, which is the lesser of 90% of $5,764, which is what she's estimating her tax liability to be, so 97% of the current year, because she's under $150,000 of AGI. She can use the 90 and 100%. Or $7512, which was the amount the last year. She gets to take the lesser of those two. So as long as she pays in that $5,764, now keep in mind, that's still an estimate. That $5,764 is an estimate. This is how much she thinks she's gonna earn. So to really be safe, if she's got the money, she should probably pay this in. Because if it turns out that that's actually higher, like say she sold a bunch of paintings and her liability was actually $10,000. Well, now she doesn't get the benefit of that safe harbor. She's outside of the safe harbor if she's paid in $5,764. Does that make sense? So you know how much the amount is going to be if you base it on that, and if you base it on 100% of the amount you paid this year. You know that. If you're basing it on 90% of the next year, you're estimating it, right? So when I did estimated payments, it was always based on what I knew, not what I thought was going to happen, right? So yes, you might be paying in a little bit extra because it's 100% instead of 90%. However, you know that number, right? So she's going to pay, so what you would do is figure out, if they're using the 90%, then we take the $5,764 minus what she's having withheld, $4,100. She's going to owe an additional $1,088. That's just over that $1,000, but still, to be on the safe side, they'd want to do that. Well, like I said, if they were being on the safe side, they'd tell her $7512. We're going to base it on that, but so she's got to pay those in 4 equal installments of $272 by the due dates. If her tax liability actually turns out to be exactly $5,764, she's still gonna owe $576 because that 5764 liability minus the withholding minus the estimated payments of 1088. So she's still gonna owe, but she's not gonna have any penalties, right? And that's what we're trying to avoid here, are the penalties. Well, I mean, you wanna pay the tax too. It's just a lot easier to come up with. It's easier to come up with $300 4 times a year than it is to come up with $1,100 at the end of the year, usually. Okay. Other payments, so if there was an error in the amount of, okay. So if there was an error in the amount of Social Security or Medicare tax that was withheld, if it was over withheld, then that will be included in your payments toward your income tax. So, and that can happen, if you recall, those of you who've been in payroll tax, remember we talked about that wage base, that Social Security wage base, and if somebody works for multiple companies during the year, and that wage base, they're gonna withhold Social Security tax based on that total wage base, each of them. But if you had, let me try and do this. So you got employer 1, employer 2, we'll just keep it to 2. Employer 1 and employer 2. So for employer 1, and our wage base is $160,200. This is our Social Security wage base. Okay. Employer 1, the employee, made $100,000. July 1st, they went to a new employer, they made $100,000. For a total of $200,000 in wages. $200,000 is over the wage base. But each of these individual employers withheld on all of this income because that wage base was not exceeded at any of these individual employers. So 7.65% is $76.50. This is our Social Security and Medicare tax. That was withheld. $76.50 was withheld here, which gets us to $15,300. However, our Social Security tax that we should have paid, that we were liable for, was $16,200 times 7.65%. How much is that? Oh, I did this wrong though. I based this on Medicare as well. Social Security tax, sorry, $6,200. It's only $6,200 plus $6,200. This is just the Social Security tax, so $12,400. So this should be 6.2. So what's 6.2% of 160,200? So this is paid.
I don't know if it's right because my calculator sucks. 9,932.40. Let me double check.
Is that what others got? Okay. Their Social Security that they are liable for during the year was $9,932.40, but what they paid in was $12,400. They get a refund of that, and it gets applied to their income taxes. So that's kind of acts. There's another line on your 1040 that shows excess Social Security something or other. I can't remember exactly the wording, but that's on there too. So that would get applied, even though it's Social Security tax, it gets applied to your income taxes. So that's where that reconciliation comes in for those amounts. You can get up to a 6-month extension of time to file your tax return. So October 15th is the final deadline for filing your tax return. That is not an extension of time to pay. Your taxes are still due by April 15th. If you don't pay it, it turns out that you didn't pay enough, again, you're gonna pay a penalty, probably some interest as well on that tax, the amount of tax that was due in that 6-month period of time. It's an automatic, well, I shouldn't say it's not. It's automatically granted. You do have to file a form 4868, but it's never, it won't be rejected. Like you apply for it, but it's automatically accepted. Okay, I don't need that. Tax refunds, you've already know where that goes because you've worked on your Tax Act problem. You've seen that. That's got a refund in it. You have a couple of choices. You can receive your refund, and you can receive it in the form of a check or have it direct deposited. Or if you think you're going to owe next year, you can tell the IRS to keep it and apply it to next year. Maybe you have estimated payments that you're going to have to make. And remember, your first estimated payment is due April 15th. If you're filing your tax return close to April 15th, and you're gonna have to make your first estimated payment April 15th, and you are owed a refund, well, you might as well just tell them to keep it and apply it to that first estimated payment, right? Then it would reduce or maybe even eliminate that first estimated payment that you have. So you can apply the excess to next year's tax return. So there are a lot of people do that. Let's see, and then there's the penalties. Questions? Tax due. I guess I did have more to say on this than I thought. Oh, okay.